Today, we're diving deep into one of the hottest topics in real estate and mortgages, the age-old debate of variable versus fixed rate mortgages. It's a decision that puzzles many, and I've noticed that there's a lot of confusion and misconceptions surrounding the choice. So we're going to clear the air today. I'm going to guide you through the ins and outs of making this critical decision, and by the end of the video, I hope to shed some light on the path that's right for you. And guess what? The way that you should decide between a fixed and a variable rate might just catch you off guard. Additionally, we're not just stopping there. We'll also delve into a situation that often puzzles many. What to do when fixed rate mortgages are surprisingly cheaper than their variable counterparts. We'll explore the unique benefits that fixed rate mortgages offer, aiming to provide you with a deeper understanding and helping you to choose the one that aligns perfectly with your financial goals. But hold up, there's even more. At the end of the video, I'm excited to share links to additional videos on mortgages. Because fixed versus variable rates is just one piece to the puzzle, and there's so much more to making the right decision. That's why I'll be giving you a comprehensive overview covering all the different aspects of choosing the best mortgage and hopefully some much needed clarity. Especially if you're still on the fence after today's discussion, these videos will be invaluable. Diving into the intricacies of mortgage selection, let's address what steps you should consider whether you're leaning towards a fixed rate or a variable rate mortgage. Kicking things off for those contemplating a fixed rate path, this choice often aligns with individuals who prioritize stability over speculation. If the predictability of your monthly payments and the steadiness of your interest outlay resonate with you, then securing a fixed rate mortgage might just hit the mark. Particularly, 5-year fixed rate mortgages with comprehensive features are the standout as the go-to option for many. Emphasizing the importance of opting for a fully featured mortgage over a discounted variant cannot be overstated. Not only does this safeguard your future refinancing flexibility in the case that interest rates decline, but also positions you to minimize potential penalties, a crucial consideration for any mortgage holder. Interestingly, a common misconception is the appeal of getting a mortgage through a major bank. However, here's a crucial tip. Big banks usually charge bigger penalties if you break your mortgage early when interest rates are going down. This could stop you from getting better rates later on. Therefore, it's really important to avoid big banks that have high fees for ending your mortgage early and mortgage companies with lots of rules that trap you. Be especially careful of something called a bona fide sale clause. This rule can stop you from moving your mortgage to another lender without paying extra money if interest rates go down. So who are the best lenders that give you everything? Good options, low fees for leaving early, and the chance to change lenders if you want. MCAP, First National, and CMLS are our top picks. Our clients really like them not only because of their good rates, but also because they don't charge a lot if you end your mortgage early and they offer flexible mortgages. But remember, these companies also have cheaper mortgage options with less benefits. So make sure you choose their full service mortgages to avoid getting stuck with a deal that looks good at first but has a lot of restrictions. For people who prefer variable rate mortgages, thinking long-term is usually the way to go. It might not matter much if you pick a big bank or a specialized lender, sometimes called monoline lenders or A++ lenders. But if you're thinking about switching to a fixed rate later, big banks might not be the best choice because they charge big fees for making that change. Also, variable rate mortgages can either have set payments or changeable payments. We really suggest going with the changeable payment option. This way, if interest rates change, your payments change little by little. This makes it easier to handle your money smoothly instead of getting hit with a big payment increase all at once. Back in 2022, this is what happened to many people when interest rates went up quite a bit. When it comes to the big banks, Scotiabank is the only one that offers the option to adjust your payments if you have a variable rate mortgage. If you really need to get your mortgage from a big bank, Scotiabank could be the way to go because of this. But generally, we're all for the smaller, top-tier lenders who almost always offer mortgages with adjustable payments. And just so that you know, I've always chosen a variable rate mortgage with an adjustable payment. I found that having the flexibility to adjust payments makes more financial sense than sticking with fixed payments, especially for variable rate mortgages. If you're leaning towards a variable rate mortgage, there's a smart move you might need to think about, especially when we hit a situation where fixed rate mortgages become cheaper than variable rates. This can happen in what's called a yield curve inversion. I'll get into the specifics of this in another video, but basically when fixed rates drop below variable rates, it might be smarter money-wise to go for a fixed rate mortgage. In these cases, picking a short-term mortgage like 2 or 3 years is usually the best move. This short period often covers a time when variable rates might be higher than fixed rates. And let's dive a little bit deeper into what we mean by a yield curve inversion. It's a bit like a graph showing interest rates for loans that last for different amounts of time. Usually it makes sense that if you're borrowing money for a shorter time, you get a better rate than if you're borrowing for a longer time. But sometimes, especially when a recession is coming or the Bank of Canada is raising rates fast, short-term rates jump above long-term rates. This flip makes fixed rate mortgages suddenly look more attractive since their prices are tied to how these bond rates behave, unlike variable rates, which follow the Bank of Canada's lead. Right now, for example, you might see variable rates at around 6%, but fixed rates are lower, around 5%. Because of this, a lot of people are choosing to go with fixed rate mortgages for 2 or 3 years at this point in time, aiming to lock in payments that won't go up for a while and to snag a rate that's actually a bit better than if they went with a variable rate. Even though switching to a short-term fixed rate might not seem like the usual move for someone who prefers variable rates, there are times when it's actually a smart play. Now, let's break down the main differences between fixed and variable rate mortgages because it's key to know these distinctions. Each type has its benefits. Choosing a fixed rate mortgage gives you peace of mind because you know your interest rate won't change for the whole term of your mortgage. You know exactly what you're paying, which is great for planning your finances. On the flip side, variable rate mortgages have some perks too, like usually having lower fees if you decide to pay off your mortgage early. This is usually just 3 months of interest. They're also more flexible when it comes to changes in interest rates. If rates go down, your mortgage rate goes down too, which means you could end up paying less than you would on a fixed rate that stays the same for years. But if rates go up, you'll feel that hit right away. A fixed rate mortgage basically changes its rate every 5 years, not based on what the Bank of Canada decides with variable rates. So if interest rates go up, people with fixed rate mortgages will still see their rates go up eventually, just not right away. This delay might seem good at first because it shields you from immediate increases, but eventually you'll still have to deal with higher rates. Plus, choosing a fixed rate usually costs more since you're paying the bank to keep your rate the same for a long time. And just to wrap up, it's pretty clear that variable rates often do better than fixed rates. This isn't just a guess. It's backed up by the actual math and facts about how mortgage rates work. Variable rates tend to outdo fixed rates most of the time, even when rates are going up. But choosing between variable and fixed rates isn't just about trying to beat the market. It's more about what makes you feel comfortable. Are you okay with your rate changing based on the Bank of Canada's decisions? Or do you prefer knowing your rate won't change for 5 years? If you're thinking about trying to time your next mortgage to get the best rate, remember, timing the market is really hard. Some people in 2021 and 2022 chose fixed rates thinking they could predict interest rate hikes, and you'll hear from those people who got it right, but many don't talk about when they got it wrong. To sum it up, finding the right mortgage is about knowing how much risk you're okay with, understanding your money situation, and picking the right lender carefully. It doesn't matter if you choose a fixed or variable rate. The most important thing is to pick a mortgage that fits what you need right now, but also lets you adjust if things change with your money in the future. And as promised, at the end of this video, I'll provide links to additional important videos about mortgages. So make sure you check them out in order to get a comprehensive understanding of which mortgage option aligns best with your needs and preferences so that you don't make the wrong decision. And if you're thinking about buying or selling in the near future in my marketplace of Surrey, Langley, and the rest of Greater Vancouver, and you want to get some tailored advice based on your unique situation, you can scroll down and click the first link in the description to book a buyer consultation, seller consultation, or just a general discovery call with me at a time that works best for you. If you're aiming for a pre-approval, especially one that's fully underwritten, the simplest route is to apply online through the link provided below. For those who aren't quite ready to take the plunge but want to get an idea of what they qualify for, I've also included a link to an online mortgage app. This tool can give you a snapshot of potential qualifications and rates before committing to a pre-approval. And if you're ready to explore mortgage options or just curious about what you might qualify for and don't already have a mortgage broker you plan on using, send me an email and I'd be happy to provide you with some top-notch recommendations. Don't forget to subscribe to our channel for more insightful content, and if you do have any questions, leave them down below in the comments. Thanks so much for watching, and we look forward to seeing you in the next video.